Safe Strategies for Financial Freedom by Van K. Tharp. Book summary in English. What if I told you that financial freedom isn't about risky gambles and get-rich-quick schemes? What if it's about building a solid foundation, one safe and smart move at a time? Welcome back to Power Books, the channel where we take powerful ideas and turn them into actionable steps. And today we're diving into a project that could completely change your future. Safe Strategies for Financial Freedom. In this series, we're going to break down the most critical parts of this book. We'll talk about how to master your cash flow, conquer debt, and build an emergency fund that actually protects you. We'll also explore the safest ways to grow your wealth, from understanding index funds to leveraging retirement accounts. So, if you're ready to stop worrying about money and start building a future of security and peace of mind, make sure to hit that subscribe button and ring the bell so you don't miss a single episode. Let's unlock your financial power together. Part 1. The Foundation of Financial Freedom. Chapter 1. The Mindset of a Safe Investor. Before we talk about budgets, investments, or anything else, we have to talk about the most important part of your financial journey: your mindset. Many people think financial success is all about complex math and secret strategies. But the truth is, it's really about your approach to money. It's about being calm, consistent, and patient. If you can get your mindset right, all the other steps will fall into place. The psychology of money. Our feelings about money are powerful and often get in the way of making good decisions. For example, have you ever felt the fear of missing out, FOMO, when you hear about someone making a lot of money on a hot new stock? Or maybe you felt panic when the news talks about a market crash. These are emotional biases at work, and they can lead you to buy high and sell low, the exact opposite of what you want to do. A safe investor understands these feelings but doesn't let them take control. They make decisions based on a well-thought-out plan, not on headlines or hype. They know that investing is a marathon, not a sprint, and that small, consistent actions over a long time are far more effective than trying to time the market. Defining your financial freedom number. Financial freedom isn't the same for everyone. For some, it might mean having enough money to retire early. For others, it might mean having enough money to take a break from work or pursue a passion without financial stress. The first step to achieving it is to define what it means for you and put a number on it. Your financial freedom number is simply the amount of money you need invested so that the income it generates can cover all of your living expenses. You can figure this out with a simple calculation. 1. Add up your annual expenses. How much do you spend in a year on housing, food, transportation, and other bills? Let's say it's $50,000. 2. Multiply that number by 25. Why 25? Because financial planners often use the 4% rule, which suggests you can safely withdraw about 4% of your savings each year without running out of money over a 30-year period. Multiplying by 25 is the same as dividing by 4%. So, if your annual expenses are $50,000, your financial freedom number is $150,000. This is your personal target, a goal that is specific to your life and gives you something concrete to work toward. The power of compounding and long-term thinking. Think of compounding like a snowball rolling down a hill. At first, it's just a small ball of snow. But as it rolls, it picks up more and more snow, getting bigger and bigger at an accelerating rate. In the world of money, compounding is when your earnings start to generate their own earnings. For example, if you invest $100 and it earns $10, you now have $110. The next time you earn, you'll earn on the $110, not just the original $100. This effect is slow at first, but over decades, it becomes incredibly powerful. This is why long-term thinking is so important. Your greatest ally in building wealth isn't a clever investment. It's time. The earlier you start, the more time compounding has to work its magic. A safe investor focuses on this long-term growth and doesn't get rattled by short-term market ups and downs. The most important thing to remember from this chapter is that your mindset is the foundation of your financial life. Are you ready to start building that foundation with a calm, patient, and long-term perspective? Chapter 2. Conquering your cash flow. To build a solid financial foundation, you have to get a handle on your cash flow. Cash flow is simply the money coming in, your income, and the money going out, your expenses. By understanding and controlling this flow, you can direct your money toward your goals instead of wondering where it all went. The goal isn't to be restrictive, but to be mindful and intentional with every dollar. Building a sustainable budget. Many people cringe at the word budget. But a budget isn't about telling you what you can't have. It's a plan for your money that helps you achieve what you really want. A good budget is flexible, realistic, and easy to follow. A simple way to start is with the 50-30-20 rule. This rule suggests you divide your after-tax income into 3 categories. 50% for needs. This covers essential living expenses like housing, groceries, utilities, transportation, and minimum loan payments. 30% for wants. This is for everything else that isn't essential but improves your quality of life, such as dining out, hobbies, subscriptions, shopping, and entertainment. 20% for savings and debt repayment. This is the most crucial part. This portion goes toward building your savings, investing for the future, and paying off any debt above the minimum payments. The beauty of this rule is its simplicity. It gives you a clear framework without forcing you to track every single purchase. If you don't fit perfectly into these percentages, that's okay. You can adjust them to fit your life as long as you're prioritizing that 20% for savings and debt. Automating your savings and bills. One of the most powerful things you can do to improve your finances is to remove yourself from the equation. By automating your finances, you ensure that money is working for you before you even have a chance to spend it. Here's how to do it. 1. Set up direct deposit. Arrange for a portion of your paycheck to go directly into a savings or investment account. This is the ultimate pay yourself first strategy. 2. Automate your bills. Set up automatic payments for all your monthly expenses, especially loan payments and credit card bills. This helps you avoid late fees and protects your credit score. 3. Use different accounts. Consider having separate bank accounts for your main checking, your emergency fund, and your long-term savings. This makes it harder to accidentally spend money you've allocated for a specific purpose. Eliminating high-interest debt. Debt, especially high-interest debt like credit card balances, is a major roadblock to financial freedom. It's like trying to run with a heavy weight tied to your back. The interest you pay on this debt eats into your cash flow and works against the compounding effect. To tackle debt, you can use one of 2 popular methods, the debt snowball. You pay off the smallest debt first while making minimum payments on the others. Once the smallest debt is paid, you take the money you are paying on it and add it to the payment for the next smallest debt. This method gives you psychological wins and keeps you motivated. The debt avalanche. You focus on paying off the debt with the highest interest rate first. This is mathematically the most efficient method because it saves you the most money in interest over time. Whichever method you choose, the key is to be consistent and aggressive in your repayment. Once you've conquered high-interest debt, the money you are using for those payments can be redirected toward building your wealth. Chapter 3. The Emergency Fund, Your Financial Safety Net. The next step in building your financial foundation is to create a financial safety net, your emergency fund. Think of it as a personal insurance policy against life's curveballs. We all face unexpected expenses, whether it's a car repair, a sudden medical bill, or a job loss. Without an emergency fund, these events can derail your financial progress and force you into high-interest debt. With one, they become just bumps in the road. Why an emergency fund is non-negotiable. An emergency fund is a stash of cash that is easily accessible and kept separate from your daily spending money. Its sole purpose is to protect you from unexpected financial shocks. It prevents you from having to sell investments at a bad time, borrow from your retirement accounts, or rack up credit card debt. Having this buffer provides immense peace of mind and allows you to stay on track with your long-term goals, even when things go wrong. How to calculate the right size for your fund. The size of your emergency fund depends on your personal situation. The general rule of thumb is to save enough to cover 3 to 6 months of essential living expenses. To figure out your number, look back at your monthly budget. Tally up all your essential needs: housing, utilities, groceries, insurance, etc. Then multiply that number by 3 and by 6 to get your target range. Example: if your essential monthly expenses are $3,000, your target range for an emergency fund would be between $9,000, 3 months, and $18,000, 6 months. If you have a very stable job and a dual-income household, you might be comfortable with the lower end of that range. If you are a single earner, work in an unstable industry, or have family members who depend on you, aiming for 6 months or more is a safer bet. The best place is to keep your emergency savings. Because the purpose of this money is to be safe and readily available, it should be kept in a highly liquid and secure account. This means it should not be invested in the stock market, where its value could suddenly drop. The best place to keep your emergency fund is in a high-yield savings account, HYSE. These accounts are perfect because they offer several key benefits. Security. They are insured by the government, FDIC in the US or CDIC in Canada, so your money is safe. Accessibility. You can easily withdraw the money whenever you need it without penalty. Growth. They earn more interest than a regular checking or savings account, so your money grows slowly over time without any risk. Once you have your emergency fund fully funded, you can then focus on directing your money towards other goals, like paying off debt or investing for retirement. Chapter 4. Conquering Debt. Now that you have a solid emergency fund in place, it's time to tackle debt. Not all debt is created equal, but high-interest debt, like credit card balances, can be a major obstacle to financial freedom. It acts like a powerful headwind, making it incredibly difficult to move forward. The goal of this chapter is to give you a clear plan to eliminate this debt so you can redirect that money toward building wealth. Understanding good versus bad debt. It's helpful to think of debt in 2 categories. Bad debt. This is debt taken on to buy things that lose value or things you consume, like credit card balances, personal loans, or store credit. This type of debt usually comes with high interest rates and doesn't help you build wealth. It's the most urgent type of debt to eliminate. Good debt. This is debt taken on to acquire assets that have the potential to grow in value or generate income, like a mortgage on a home that appreciates or a student loan for an education that increases your earning potential. While you still want to manage this debt responsibly, it's not as financially destructive as bad debt. Strategies for paying down debt efficiently. There are 2 popular and highly effective methods for paying off debt. Both work, so the best one for you is the one you will stick with. 1. The debt snowball. With this method, you pay off your debts from smallest balance to largest. You make minimum payments on all your debts except for the one with the smallest balance, which you pay off as aggressively as possible. Once that debt is gone, you take the money you were paying on it and snowball it into the next smallest debt. This method focuses on quick wins and building momentum. 2. The debt avalanche. With this method, you pay off your debts from highest interest rate to lowest. You make minimum payments on all your debts except for the one with the highest interest rate, which you pay off as aggressively as possible. This is the most mathematically efficient method because it saves you the most money and interest over time. How to manage and maintain a good credit score. As you're paying down your debt, it's important to also focus on your credit score. Your credit score is a 3-digit number that tells lenders how trustworthy you are with borrowed money. A good credit score can save you thousands of dollars over your lifetime through lower interest rates on mortgages, car loans, and other forms of credit. Here are a few key actions to take. Pay your bills on time. This is the most important factor in your credit score. Make sure all your payments are made before their due dates. Keep your credit utilization low. This refers to the amount of credit you're using compared to your total available credit. A good rule of thumb is to keep this below 30%, but ideally below 10%. Don't close old credit accounts. The length of your credit history also matters. Keeping old, unused credit cards open can help your score, as long as they don't have an annual fee. By consistently applying these principles, you will not only free yourself from the burden of debt, but also build a strong credit history that will open up new financial opportunities. Part 2, Safe and Sustainable Wealth Building. Chapter 4, An Introduction to Passive Investing. With your financial foundation built, a good mindset, managed cash flow, and a safety net in place, you're ready for the next phase, making your money work for you. This is where investing comes in. But for a safe investor, this doesn't mean trying to pick the next winning stock. It means using a disciplined, long-term approach called passive investing. The dangers of active trading. Active trading involves frequently buying and selling stocks, trying to beat the market. While it can sound exciting, it's very difficult and risky for most people. Even professional traders struggle to consistently beat the market averages. Active trading often leads to high fees, impulsive decisions based on emotion, and poor results. A safe investor understands that trying to time the market is a losing game. Instead of trying to find the next big thing, they focus on a strategy that guarantees they will capture the growth of the market over time. Understanding index funds and ETFs. So, what is passive investing? It's the strategy of buying and holding a broad collection of investments, rather than trying to pick individual winners. The easiest way to do this is with index funds and ETFs, exchange-traded funds. An index fund is a type of mutual fund that is designed to match the performance of a specific market index, like the S&P 500. Instead of a fund manager picking stocks, the fund simply buys a tiny piece of every company in that index. When you invest in an S&P 500 index fund, you are instantly invested in 500 of the largest companies in the U.S. in a single purchase. An ETF is very similar to an index fund, but it trades on the stock market like a regular stock. This means you can buy and sell it throughout the day, though for a long-term passive investor, this doesn't matter much. Both index funds and ETFs are excellent tools for a safe investor because they are diversified. You are not putting all your eggs in one basket. If one company struggles, it won't ruin your investment. They have low fees. Because there's no expensive fund manager actively picking stocks, the costs are much lower, which means more of your money stays in your pocket. They are simple. You can build a well-diversified portfolio with just a handful of these funds. Building a simple, diversified portfolio. A diversified portfolio is one that holds a variety of different assets, so that if one area of the market performs poorly, another might perform well. A simple, safe portfolio could include U.S. Stock Index Fund, invests in a broad range of U.S. companies. International Stock Index Fund, invests in companies outside the U.S. Bond Index Fund, invests in a collection of government and corporate bonds. Bonds are generally less risky than stocks and can help stabilize your portfolio. By investing in these three types of funds, you are instantly diversified across different companies, countries, and asset types. This is the cornerstone of a safe, sustainable investment strategy that doesn't require you to be a market expert. Chapter 5. The Power of Retirement Accounts. After building a simple, diversified portfolio, the next step is to use special accounts that are designed to help you save for the future in a powerful, tax-advantaged way. These are your retirement accounts, such as a 401k and an IRA. They are some of the most effective tools for building long-term wealth, and it's a mistake to overlook them. Maximizing your 401k and IRA. A 401k is a retirement savings plan offered by an employer. It allows you to contribute a portion of your paycheck before taxes are taken out directly to an investment account. Many employers will also offer an employer match, where they contribute a certain amount of money to your account for every dollar you contribute. This is essentially free money, and you should always contribute at least enough to get the full match. Missing out on the employer match is like turning down a pay raise. An IRA, individual retirement arrangement, is a retirement account that you can open on your own, separate from an employer. There are two main types. Traditional IRA, your contributions might be tax deductible, and your money grows tax deferred. You'll pay taxes when you withdraw the money in retirement. Roth IRA, you contribute money that has already been taxed. Your money then grows completely tax-free, and you won't pay any taxes when you withdraw it in retirement. The best choice between a traditional and Roth IRA depends on your current income and what you expect your tax rate to be in the future. If you think you'll be in a higher tax bracket later, a Roth IRA might be the better choice. Understanding tax-advantaged growth. The real power of a 401k and an IRA comes from their tax advantages. In a regular investment account, you pay taxes on any gains you make each year. In these retirement accounts, your money grows either tax-deferred or tax-free. This is a huge benefit because it means the full amount of your earnings can be reinvested and compounded over time without being reduced by taxes. This allows your money to grow much faster. For example, a small amount of money invested in a Roth IRA in your 20s can grow to be a very significant tax-free sum by the time you retire. The importance of starting early. The single most important factor when saving for retirement is time. Because of the power of compounding, a person who starts saving in their 20s will likely have far more money in retirement than someone who starts in their 30s, even if the person who started later contributes more money each year. For a safe investor, the strategy is simple. Start as early as you can, contribute consistently, and take full advantage of any employer match. This slow and steady approach is the safest and most reliable path to a comfortable retirement. Chapter 6. Diversifying beyond the stock market. A safe and sustainable wealth-building strategy is all about diversification, which means not putting all your eggs in one basket. While index funds are a fantastic way to diversify within the stock market, a truly safe investor looks beyond stocks to other types of assets. These other assets can help protect your portfolio during market downturns and provide more stable returns. This chapter will introduce you to two key areas of diversification: bonds and real estate. The role of bonds in a safe portfolio. Bonds are essentially loans you make to a company or a government. In return, they promise to pay you back your original investment plus interest over a set period of time. When you invest in a bond, you're acting as the lender. Bonds are generally considered less risky than stocks. While the value of a stock can be very volatile, bonds provide a more stable stream of income. For this reason, bonds are often used to balance out the risk of a stock portfolio. When the stock market is doing poorly, bonds often hold their value or even increase, helping to protect your overall wealth. The easiest way to invest in bonds is through bond index funds or ETFs, which we discussed in the last chapter. These funds hold a collection of many different bonds, which spreads the risk even further. A good rule of thumb for a safe investor is to have a mix of stocks and bonds that aligns with their risk tolerance and age. As you get closer to retirement, you might want to increase the percentage of bonds in your portfolio to reduce risk. An introduction to real estate investment. Real estate is another powerful way to diversify your wealth. It has two main benefits. It can increase in value over time, and it can generate passive income through rent. For a safe investor, there are a few ways to get started without becoming a landlord. REITs, real estate investment trusts. A REIT is a company that owns and often operates income-producing real estate. Think of it like a mutual fund for real estate. You can buy shares in a REIT just like you would a stock or an ETF, and it gives you exposure to the real estate market without the work of buying and managing properties yourself. Rental properties. This is the traditional way to invest in real estate. You buy a physical property and rent it out to tenants. This can be a great way to build wealth and generate income, but it's important to remember that it comes with more work and risk than simply buying a REIT. It requires significant capital, and you're responsible for maintenance, management, and finding tenants. For those just starting, investing in REITs or a real estate-focused ETF is often the safest and easiest way to add real estate to a portfolio. Part 3. Protecting your future. Chapter 7. A simple guide to estate planning. After all your hard work building a solid financial foundation and growing your wealth, the final step is to protect it for the future. Estate planning isn't just for the wealthy. It's a crucial part of securing your legacy and ensuring your loved ones are taken care of. This chapter will cover the basics in a simple, straightforward way, so you can feel confident that your wishes will be respected. The importance of a will and trust. A will is a legal document that outlines how you want your assets to be distributed after you pass away. It allows you to name an executor, the person who will handle your affairs, and specify who will receive your money, property, and other possessions. Without a will, the state will decide how to divide your assets, which may not align with your wishes. A trust is another legal tool that allows you to hold assets for the benefit of a third party. Trusts can be a bit more complex than a will, but they offer some key benefits. They can help your heirs avoid a lengthy and public process called probate. They can provide more control over how and when your assets are distributed. They can offer some privacy, as trusts are generally not public records. For most people just starting out, a simple will is a great first step. As your wealth grows, you can explore whether a trust makes sense for your situation. Designating beneficiaries. When you open retirement accounts, like a 401k or IRA, or get a life insurance policy, you will be asked to name a beneficiary. A beneficiary is the person or people who will receive the assets in that account after you're gone. It is absolutely critical to keep these beneficiaries up to date. Unlike a will, which might go through probate, assets with a named beneficiary will pass directly to that person. If you get married, divorced, or have children, you should immediately update your beneficiaries on all your accounts. Forgetting to do this can cause major legal and financial headaches for your family. Understanding powers of attorney. Estate planning isn't just about what happens after you're gone. It's also about what happens if you're unable to make your own decisions. A power of attorney is a legal document that gives someone else the authority to act on your behalf. There are two main types. Financial power of attorney gives a trusted person the authority to manage your finances, pay bills, and make other financial decisions if you are unable to. Medical power of attorney gives a trusted person the authority to make medical decisions for you if you become incapacitated. These documents are a simple and powerful way to ensure that your life can continue to be managed by someone you trust if the unexpected happens. Chapter 8. Navigating Economic Changes. A safe investor knows that the economy is always changing. Markets go up and down, and the value of money itself can change due to inflation. This final chapter in Part 3 will equip you with the knowledge to protect your wealth through these changes, ensuring your long-term plan stays on track no matter what the headlines say. Protecting your wealth from inflation. Inflation is the rate at which the price of goods and services increases over time. For example, if you can buy a loaf of bread for $3 today, but it costs $10 next year, that's inflation at work. Inflation slowly erodes the buying power of your money. The dollar you have saved today will not buy as much in the future. This is why simply saving cash is not enough to build long-term wealth. To protect your money from inflation, you need to invest it in assets that are likely to grow faster than the rate of inflation. Stocks and real estate. Over the long term, these assets tend to outpace inflation. When you own a piece of a company, that company can raise its prices to keep up with inflation, and its value will likely increase. Tips. Treasury inflation-protected securities. These are a type of U.S. government bond designed specifically to protect against inflation. Their value adjusts with the Consumer Price Index, CPI, ensuring your principal keeps up with rising costs. Understanding market cycles and volatility. The stock market doesn't go up in a straight line. It has its ups and downs, which are called market cycles. A bull market is a period of strong growth, while a bear market is a period of decline. For a safe investor, it's crucial to understand that this volatility is normal. It's part of the process. Trying to get in and out of the market to avoid the downturns is often a mistake. People who do this often miss the best days of the market, which can have a significant negative impact on their returns. Staying disciplined during downturns. The most challenging time for an investor is during a market downturn. It's easy to panic and want to sell everything to stop the bleeding. However, a safe and experienced investor does the opposite. They stick to their long-term plan. Don't sell. The number one rule is to not sell your investments in a panic. The market has always recovered from every crash in history, and selling during a downturn locks in your losses. Keep investing. If you can, a downturn is actually a great time to buy. When the market is down, you are essentially buying assets at a discount. A dollar cost averaging strategy, investing a fixed amount of money at regular intervals, is particularly effective here because it forces you to buy more shares when prices are low. Focus on what you can control. You can't control the market, but you can control your savings rate, your spending, and your emotional reactions. Focus on these things and trust that your long-term, diversified strategy will work. By staying calm and disciplined through the ups and downs of the economy, you will ensure that the wealth you've built continues to grow and serve you in the long run. Chapter 9. The right insurance for your needs. Building wealth isn't just about saving and investing. It's also about protecting what you have. A safe investor understands that insurance is a critical tool for managing risk. Think of it as a defensive player on your financial team. It won't score goals, but it will protect you from a devastating loss. This chapter will walk you through the essential types of insurance you need to protect yourself and your family. The big picture, why insurance matters. Insurance is a contract in which you pay a regular fee, called a premium, to a company. In return, the company agrees to pay you a larger sum of money if a specific negative event happens. Why is this a safe strategy? Because it prevents a single catastrophic event, like a major car accident, a house fire, or a serious illness, from wiping out all the savings you've worked so hard to build. It's the ultimate financial safety net for things that are too big for your emergency fund to cover. Key types of insurance for a safe investor. There are many different types of insurance, but these are the most important ones to have in place. Health insurance. This is non-negotiable. Medical emergencies can be incredibly expensive and are a leading cause of bankruptcy. Health insurance protects you from these costs by covering a significant portion of your medical bills. Auto insurance. If you own a car, this is required by law in most places. It protects you from the financial fallout of accidents, covering damage to your car, the other person's car, and any injuries. Homeowners or renters insurance. If you own a home, this insurance protects it and your belongings from damage or theft. If you rent, renter's insurance is just as important. It protects your personal possessions, and it often includes liability coverage if someone gets hurt on your property. Life insurance. This is crucial for anyone with financial dependents, a spouse, children, or a parent who relies on you. In the event of your death, a life insurance policy provides a lump sum of money to your beneficiaries, allowing them to pay off debts, cover living expenses, and secure their financial future. Disability insurance. This insurance replaces a portion of your income if you become unable to work due to an injury or illness. If you rely on your paycheck to live, this is a vital piece of your financial safety net. Avoiding common pitfalls. When it comes to insurance, two common mistakes are overpaying and being underinsured. Underinsured. This happens when your coverage is not enough to protect you from a major event. For example, having a homeowner's policy that doesn't cover the full cost of rebuilding your home after a fire. Overpaying. This happens when you have too much coverage or are paying for a policy you don't need. It's important to shop around, compare rates, and review your policies regularly to make sure you're getting the best value. By having the right types of insurance in place, you are building a robust financial defense system. You are protecting your assets and your future, so you can continue to build wealth without fear of a single event undoing all your progress. Chapter 10. The basics of estate planning. As you build and protect your wealth, you're not just thinking about yourself. You're also thinking about your loved ones. Estate planning is the process of making sure your assets are distributed according to your wishes, and that your family is taken care of if something happens to you. It's a key part of responsible financial management, and a simple, loving act that provides peace of mind. You don't need to be wealthy to do it. You just need to have a plan. The importance of a will and trust. A will is a legal document that states how you want your property and possessions to be distributed after you pass away. In your will, you can name an executor, the person who will manage your affairs, and specify who will inherit your assets. Without a will, the state will decide how your assets are divided, which may not be what you would have wanted. A trust is another tool that can hold assets on behalf of a beneficiary. While more complex, trusts can be very useful for avoiding probate. The legal process of proving a will is valid. Trusts often allow assets to be passed directly to heirs, saving time and money. Privacy. Unlike wills, which are public records, trusts are private. Control. You can set specific conditions for how and when your assets are distributed. For most people, a will is the perfect starting point. As your financial life becomes more complex, you can explore whether a trust is a good fit. Designating beneficiaries. When you open retirement accounts, like a 401k or IRA, or take out a life insurance policy, you are asked to name a beneficiary. This is the person who will receive the money in that account after you die. This is an extremely important step and often more powerful than a will. Assets with a named beneficiary will pass directly to that person, bypassing the will and the probate process. It is absolutely essential to keep your beneficiaries up to date. If you get married, divorced, or have children, you must update the beneficiaries on all your accounts. Forgetting to do so can cause major complications for your family. Understanding powers of attorney. Estate planning isn't just about what happens after you're gone. It's also about preparing for a time when you may not be able to make decisions for yourself. A power of attorney is a legal document that gives a trusted person the authority to make decisions on your behalf. There are two main types. Financial power of attorney. This document authorizes a person to manage your financial affairs, such as paying bills and handling bank accounts, if you are incapacitated. Medical power of attorney. This document gives a person the right to make medical decisions for you if you are unable to do so. Having these documents in place ensures that a person you trust can step in and manage your life according to your wishes if the unexpected happens. Chapter 11. Final thoughts. Living a life of financial freedom. You've made it to the end of our journey. We've gone from the very basics of your financial mindset all the way to protecting your legacy. This final chapter isn't about new strategies or complex ideas. It's a reminder of the key principles we've covered and a look at what this all means for your life. For a review of the core principles, let's quickly recap the path you've just walked. The mindset. You started by understanding that emotional decisions and market hype are a trap. Instead, you adopted a calm, disciplined, and long-term perspective. The foundation. You learned to master your cash flow, build a solid emergency fund, and aggressively eliminate high-interest debt. This gave you a safe and secure base from which to grow. The growth. You embraced the power of passive investing through index funds and ETFs, recognizing that slow and steady diversification is the safest and most reliable path to wealth. You also learned to maximize the benefits of tax-advantaged retirement accounts. The protection. Finally, you understood the critical role of insurance and basic estate planning to protect what you've built, ensuring your legacy is secure for your loved ones. The ongoing journey. Financial freedom isn't a destination you arrive at and then stop working. It's an ongoing journey of learning, adapting, and staying disciplined. The principles in this book will serve you for your entire life, but the world will continue to change. Be curious, stay educated, and remain committed to your long-term plan. The most powerful takeaway from this book is not any single strategy. It is the understanding that true financial freedom is not about having a mansion or a sports car. It's about having choices. It's the freedom to take a job you love because you're not worried about the salary. It's the freedom to spend more time with your family. It's the freedom to pursue your passions. This journey is about living a more fulfilling life, one where money is a tool you control, not a master you serve. You have everything you need to start building that future today. Go on and live a life of financial freedom. And there you have it, Power Books Nation. We've just navigated a complete blueprint for safe strategies for financial freedom. This isn't just a book about money. It's a profound masterclass in building a life of security, peace of mind, and unwavering control. We've shattered the myth that you need to take on high-risk gambles to get ahead, revealing that the real secret lies in mastering your mindset, conquering your cash flow, and most powerfully, growing your wealth with safe, consistent, and disciplined action. We've shown you that true power comes from building a solid foundation and protecting what you've earned. If you're serious about ending financial stress, taking control of your financial destiny, and charting a course to a life with more choices, then Safe Strategies for Financial Freedom is an absolute must-read that will redefine your entire approach. Grab your copy via the link in the description below, but don't stop here. For those of you who want to take your skills to the next level, another powerful book is popping up on your screen right now. It's a must-read and a must-listen to take your journey to the next level. Remember, here at Power Books, we live by the motto, knowledge is not power. The application of knowledge is power, and applying these safe strategies will undoubtedly empower your financial journey. If this summary gave you the clarity you've been searching for, make sure to smash that like button, subscribe to Power Books, and hit that notification bell so you never miss our next deep dive. Keep learning, keep applying, and keep building the freedom you deserve. Thanks for joining us, and we'll see you next time.